Hi, this is Jason, Chief Technical Analyst with Toro Alerts with your weekly market recap. We saw a pretty nice rally this week, so let's dive into the charts and see where we're heading from here. Starting out with the S&P 500, taking a look at the SPY chart. We did top out on Friday at about the 400 and maybe 401 level on the SPY, which is about a 0.382 retracement off of this down channel trend line. So that could be a potential logical place for this rally to stop and potentially head lower. But we are above the 50-day, and we did break this down channel trend line for the first time since late March, early April. And so that was a pretty significant development this week. So we'll need to see if that continues going into next week. As long as we're above the 50-day, I'd say that's a pretty positive sign. But if we do break below that 50-day and head lower, I'd call it right around 390 or so, then that would be pretty bearish development for the markets. But if we can stay above that 50-day moving average, then we might potentially head higher on this bear market rally. I'd be looking at a possible top if we can get above that 400 level again, looking at maybe 414, 415 for a possible top in the S&P 500 before we likely head lower. And then taking a look at the NASDAQ, similar story over here. We broke the 50-day, broke the down channel line actually a week ago. So the NASDAQ's actually been a relative outperform over the S&P 500 over the last couple of weeks. And we are also kind of paused out right at a 0.382 retracement level off of this down channel trend line. And so that's also a fairly logical place for this one to potentially stop. But if we can get back up above that down channel, or that 0.382 retracement, which is right around 309 on the triple Qs, then we could potentially head higher. I wouldn't probably expect a whole lot more rally here. Probably at the most we'd be looking at maybe about 309, 310 on the triple Qs, and then I'd probably expect it to head lower from there. We'll have to keep an eye on that next week as long as we're above that 50-day. That's a pretty significant development that we haven't seen since March or April of this year, and so we'll have to keep an eye on that going into next week and see where we head from here. And then take a look at the Dow Jones Industrial Averages. We also broke the 50-day and the down channel trend line on this index as well. We actually did sell off a bit on Friday, but actually stopped and held the 0.382 as support. So we've actually broken above that 0.382 retracement. And then when it sold off today, it ultimately kind of stuck that landing and closed above that 0.382 retracement. So of all the three major indices that we're looking at here to start out with, I'd say the Dow Jones Industrial Averages probably looks the most bullish since it did kind of close right above that 0.382 retracement, and so we could likely be heading higher on the Dow Jones going into next week. If we do, the next potential line in the sand to check would be 325.78, and if we can get above that level, then maybe we can rally all the way up to about 332 or so. But I'd likely expect a pretty good chance of a top out at that level, if not sooner. And then take a look at our Dow Jones Transportation Index. We've talked about this one kind of chopping around sideways for about the last 5 weeks. We did see some price action that broke that 5-week sideways choppy action, and we ultimately ended up just a little bit higher on the week compared to these last 5 weeks in the transports. And so a little bit of a bullish development there on the transports, and as long as we can continue to the upside from here, we will be looking at a potentially pretty major resistance area at the 14,373 level. That's a Fibonacci extension level that we'll be keeping a close eye on. It was acting as support for quite some time. We were above that level, and now that we're below it, it's likely going to act as a pretty strong resistance. So that'd be the next kind of major target we'll be looking at on the transports. And then looking at our Russell 3000 chart, we got our center channel line here, the L line. We got just a hair above it this week, but then it pulled back and ultimately ended the week just slightly below that center channel line. So it'll be interesting to see next week if we can get above that level. If we do, I would be looking for that 100-week moving average as the likely top in probably this next bear market rally. But it also wouldn't surprise me if it couldn't get above that center channel line and potentially headed lower from here. But a lot of their indicators and what we're seeing on these other charts is showing us that this bear market bounce might have a little bit more legs. So if we do get above that center channel line, then we'll be looking for that 100-week moving average for the next area of resistance. And then we're taking a look at the Russell 1000, our large caps. We had about 5 weeks of kind of sideways choppy action. We ultimately hit the 150-week moving average as support and stuck that landing pretty nicely, and then headed higher. Ultimately closed the week up a bit higher than we have for about the last 6 weeks, and so that's a pretty bullish development in large caps. And if we do continue to head higher going into next week, we'll be looking at that 231.25 level as a possible top, which is a Fibonacci extension level on our large caps. And then taking a look at our Russell 2000, our small caps, pretty major development here on the week. We've been below the 200-week moving average for a period of time, about 5 weeks now. And this week we definitively closed well above that 200-week moving average, as well as this 173.55 level, which is a pretty major level of support and resistance on this chart. And so as long as we're above 173.55, that's got to be fairly bullish for small caps in the short term at least. And the fact that we closed above the 200-week for the first time in a while also is a pretty bullish development. And so maybe we've got a little bit more legs left in this rally, and we could see small caps potentially heading a little bit higher as well. Then we take a look at our growth versus value chart. Growth is continuing to outperform value. We've seen about 8 or 9 weeks now of growth outperforming value, which has been very different from pretty much the trend all the way back into November of last year. We haven't seen a kind of counter trend move like this last this long since the decline started in November. So we'll see if this has some more legs to it, or if it starts to roll over pretty soon. But we are above the 200-week moving average, as well as this 1.53 level, which has been a pretty good support resistance level to watch for. And so as long as we're above both the 200-week and that 1.53 level, that's a fairly bullish outlook for the growth sector at the moment. And then we jump over here to our relative rotation graph, taking a look at the last 2 trading weeks, taking a look at some of the best and worst performing sectors. We can see at the top here, United States Natural Gas Fund has had a really big couple of weeks. We're up 27.3% on natural gas in the last 2 weeks. And that's following a bit of a correction a few weeks previous to that, but natural gas is definitely heading higher from here. We actually had a video call out on trade opportunity in natural gas just this last week, and we're actually in that trade currently, and it's been working pretty well so far. And so nat gas is looking like a good space to look for some long opportunities for the moment. And in second place, we got biotech sitting at about 10% to the upside over the last couple of weeks. We also saw ARC Innovation up 10% over the last couple of weeks. Home builders up 7%. And then consumer discretionary and semiconductors, as well as ARC FinTech, all up about 5%. So we've seen some decent sectors move to the upside over the last couple of weeks. Definitely some tradable opportunities within these sectors. And then when we scroll down to the bottom, some of our worst performers over the last couple of weeks, silver is in the doghouse, down almost 8%. Gold miners are down almost 7%. Gold shares are down 6%. We saw steel and the energy sector down about 4%. And so those are some of your worst performing sectors over the last couple of weeks. And then we're taking a look at our U.S. oil chart, jumping over to our U.S. oil, and we're sitting at about $95 a barrel right now. We are down below that $100 price level, which I was kind of had a line in the sand for as far as being bullish on energy stocks. While natural gas is looking like a nice trade right now, most of the rest of the energy space is either stalled out or is potentially selling off a little bit. And so I've been a little less bullish on energy and at least neutral on it for now. We are still above the 50-week moving average in the U.S. Barrels right now, and so as long as we can stay above that, it's still in a long-term uptrend. But at least in the short term, it's been heading quite a bit lower. You know, it was only about 4, 5, 6 weeks ago we were sitting at about $125 a barrel and thought we were heading higher, and then we had a pretty big collapse in oil down to about 95. Nice development for everybody at the gas pump, most likely, but if you were long energy stocks, it's been pretty tough the last couple of weeks. So before I'd like to see price action probably get back above, call it 107.75 on the US barrel prices for oil before I'd probably get super excited about getting back into the energy trade. Right now the XLE is just chopping around at the 200-day moving average. Hasn't lost that yet, but it's looking like it could, and so I kind of want to see some more price action develop in that space before I get long again on energy. And then taking a look at the commodity space, our CRB index, we had a pretty decent rally this week in the commodity space, but then it gave up most of those gains before the week closed out. And so just on that candlestick alone, that's generally a fairly bearish candlestick for the week, where you have a nice little rally to the upside, but then give most of it back. So we'll see where it goes from this going into next week. Still thinking there's a decent chance we'll get back down to this lower channel trend line, which also coincides with the 50-week moving average. That would potentially be a pretty logical place for support to settle in. And then from there, that'll be a real strong indicator where we go from there. If we see it hold support at that lower channel line or the 50-week moving average, and then hold that as support and then head higher, that'd be a pretty bullish development for commodities. But if we see it drop below that line as well as the 50-day, that'd be pretty bearish for commodities, I think, longer term. And then taking a look at our consumer discretionary versus consumer staples, we've had a bit of a development in this chart this week as well. As we can see, we broke this down channel trend line, which has been in place since November of last year. And so despite all the other little bear market bounces we've had, none of them have ever been able to get above that down channel trend line, but this one did. And so that's definitely a bit of a development. So we'll have to keep an eye on that and see if we continue to see consumer discretionary outperforms consumer staples. Consumer staples being defensive, consumer discretionary being bullish and more risk on. It's a good ratio chart to kind of keep our eyes on to see if people are getting more defensive or having more of an appetite for risk assets. So we'll keep a close eye on that going into next week to see if that continues to the upside. And then taking a look at our all-world index minus the U.S., we did see what looked like potentially a short-term bottom hammer candlestick developed last week, and that ultimately did put in a short-term bottom. We had a pretty decent rally on this one going into the week this week, so we'll see if we can continue higher next week. But when you look at this on relative terms, looking at our emerging markets divided by the S&P 500, it's on a relative basis still heading lower. And then we take a look at our high-yield corporate bond ETF. We talked about that 75.11 level. When we lost that, that was a pretty bearish development. Definitely a bit of a concern for the markets, but we did get back above that last week, and then this week we just continued even higher. And so I think as long as we're sitting above that 75 level on the HYG, that could be a sign that this bear market rally has a little bit more legs to go. If we see it drop down below that 75 level again, I think that'd be a big warning sign that the next leg down is likely coming. And then when we do take a look at it though on relative terms, compared to traditional bonds, it is a little less of an impressive rally on the week. It did go up, move to the upside this week, but not nearly as much on relative terms as it did on the actual HYG ETF. And then we take a look at our value line geometric index. We haven't looked at this one in a while on our videos, but this is the median stock for the stock market. And we've seen it holding support at that 510 level, which is interesting because when we scroll back and take a look at this on a historical basis, that 510 level has actually been a very major support resistance zone for about the last couple of decades. We've seen it act as resistance back in '98 as well as in 2007, for the most part around 14 and 15 as well. And then we actually got above that level in 17 and kind of held above that level for the first time in 17. Up and down a bit from there, but that 510 level looks like a very strong area of support and resistance for this geometric index. And so as long as we're above that 510 level, I think there's some decent bullish opportunities for stocks, at least in the short term, but we are pushing up against this 200-week moving average, so we'll have to keep an eye on that one and see where we go next week. And then take a look at our gold and silver markets. Gold sitting at the gold ETF is sitting about 160.95 post-market on Friday. That's the GLD that we're looking at. We're kind of expecting that one to potentially touch the 200-week moving average, which is currently sitting at about 155 on the GLD. We also have some pretty major support at 157, so somewhere around that level, 155, 157, I'll be looking for a potential bounce. And we are approaching a seasonally bullish period for gold. Now this year's been pretty unusual and historically bad, and so seasonality might have to be a bit thrown out the door, but in more normal market environments, we're entering a pretty positive period for gold on a seasonality basis. So I have to keep a close eye on that. If we do see a nice bounce off of that 200-week moving average or the 157 level, then that could be a bullish development on gold. And if we see that move to the upside from there, could be a short-term trade developing in gold, but we'll have to see that actually develop with price action first before we get in on that one. But then when we jump over to silver, we take a look at this one. We're actually headed lower on silver just a little bit this week. Closed the week out at about $17 an ounce. It's well below the 200-week moving average, so silver's just kind of been a mess for some time. And we'll probably be looking for a potential bottom on silver somewhere between about $15.50 and $16 an ounce. And then at that point, we'll probably see it head back up to the upside. We are just about oversold on the weekly RSI, which that doesn't happen too often on the weekly RSI for silver. And so generally every time we get down there, we usually see a pretty nice bounce to the upside once we do get to these oversold levels. So probably be a nice trade setup here in silver at some point, but we're not there yet, so we'll be keeping an eye on the price action on the SLV and looking for that trade setup opportunity, but we're not quite there yet. And then taking a look at our dollar index at DXY, we had a nice rollover in the dollar this week, which I think ended up being a nice tailwind for stocks. And typically when the dollar's going down, it tends to be a tailwind for the stock market. We'll see if we can continue to head lower. If we do, good chance we'll probably bounce at either 104 or 105 on the DXY, and then I still think the dollar index is heading higher from here. So this is likely a short-term correction in a longer uptrend, and so I'll be looking for that bounce at about 104 or 105, and then watching for the DXY to head higher from here. And then taking a look at our interest rates, our 2 years are sitting at about 2.97. That's sitting just barely underneath a major support resistance zone at about 2.98. So we'll see where we go from there this next week. If we do see the 2 year drop below, call it about 2.8 or so, then that might be a bit of a trend change, and maybe we'll start to think that the rates might have topped. We are seeing that across the board right now, but we've had some fake outs before, so we need to be careful on looking at bond trades. Some people have been calling for a really good opportunity to get into the bond trade now, thinking that rates might have topped in. I think we've been kind of faked out on this a couple of times, so I'm not quite convinced we're there yet. The 10-year sitting at about 2.75% currently. I probably want to see a close on the 10-year below 2.65 and see it stick and stay below that level. And if we do, then I might be looking for some trade setups in something like the TLT or the IEF. But I'm just not quite convinced yet that the bond trade setup is quite ready yet. And I've already been kind of faked out once before a while ago, and so we'll need to kind of see a little bit more movement to the downside in our interest rates before I get too excited about that bond trade. And then taking a look at our 30-year, we're sitting at just below 3% on that. I want to see the 30-year drop probably below 2.9% before I'd kind of consider it a major trend change on the 30-year rates. And then we take a look at our yield curve. Yield curve is still pretty severely negative. We're sitting at about negative 0.222%. That is a pretty extreme level. The reading going back quite some time. We've only hit that level. We've talked about this a few other times where we've only hit this level a few other times. The last time was the great financial, the banking crisis that we had in 07 and 08, and then also the dot-com bubble. And so both of those were some pretty severe corrections, 50+%, and this yield curve is sitting at those levels right now. So that's definitely a bit of an ominous signal and something to be, I think, cautious of, and another reason I think that there's a very good likelihood that we are still headed lower, more medium to long term still in the markets. But on the short term, taking a look at our VIX, the VIX keeps dropping. We actually got below the 200-day moving average for the first time since April. So that's a bit of a development in our VIX, and sitting at about 23 closing the week out. We are below the 25 level as well. So I would think that if the next time we see the stock market really sell off, we're likely going to see a spike in the VIX, at least back up above that 50-day moving average, and likely back up to 30 or even higher on the VIX. And that hasn't happened yet. It just keeps heading lower. And so we'll keep a close eye on that VIX. And as long as it's below 25, I think there's a decent chance that that bear market rally might have some legs going into next week. And then when we look at our put-call ratio, we did see some elevated put buying protection going into Friday. We are above the 1 line, so people are still being very cautious, buying some protection in the markets. And that's where we're at on that. And we'll go ahead and close it out on Bitcoin. We've seen some interesting developments in the Bitcoin chart this week. We got above the 50-day moving average on Bitcoin, and we also got right up to this down channel trend line, which has been in place since late March, early April, when Bitcoin really started selling off pretty aggressively. Late March, early April, we were sitting at almost 50,000 Bitcoin, and now we're sitting at about 22.5 Bitcoin. So I'd like to see a break in that down channel trend line to the upside, and if we can see that, then there's a decent chance that maybe we get a bounce in the crypto markets, and maybe Bitcoin can get back up to 30,000 or so. I still think we're heading lower on Bitcoin, but if we do see a break above this down channel trend line, then I think there'll be some reason for optimism that we might get a little bit of a bear market rally, which I would imagine would likely top out at around 30,000. We are kind of chopping around currently in between. We are staying above the 50-day moving average. It's been holding out as support, but we're also resisting against this down channel trend line, and so we're kind of stuck in a little bit of a neutral area right now. We need to see either a break below that 50-day moving average or a break above the down channel trend line before we kind of decide which direction Bitcoin's heading next. But if we do see that break to the upside, I think there will be some short-term potential trade opportunities in Bitcoin, as well as some of the altcoins, if we can get outside of this down channel trend line. And then longer term on Bitcoin, I've been taking a look at some of the charts more longer term and trying to figure out a potential bottom on Bitcoin. And it looks like to me that that 11,723 currently, that is a moving target, so that changes regularly, but currently that's kind of what I'm looking at for a potential bottom in the market on Bitcoin, is right around that $12,000 price target. Could be a little higher, a little lower. If we're talking more of a range, I'd probably say somewhere between 10,000 and 14,000. But I'm really looking at this anchored VWAP position, which is the anchored to the cycle bottom lows of the previous Bitcoin cycle, and I think that's a logical bottom for Bitcoin in this market. And so that's what we'll be looking for. If we see Bitcoin hit that 11,000, 12,000 level and hold that as support, I think that could be a really good entry point for some long-term Bitcoin acquisitions. But we need to get down to that level, and we're certainly not there yet. And I think before we get there, there's a decent chance we might get a little bit of a bounce to trade off of before we head lower. So we'll keep an eye on that like we always do. Thanks for tuning in, and for this week's weekly recap, make sure to download the Toro Alerts app on the App Store. We've got one for stocks and one for crypto, and make sure to like and share the video. We'll see you next time.